Welcome to KBRA Podcasts, where we cover topical research discussions, industry commentary, and more. Stay tuned for insight from our knowledgeable team members.
Hello, welcome European listeners and market participants, and welcome to KBRA's latest European Credit Podcast, Conversations in European Credit. I am Gordon Kerr, Head of European Research at KBRA, and today I'm joined by Kali Sirugudi from our European RMBS rating team here at KBRA. Today, we will be covering the topic of the Spanish housing market, where we will discuss how the Spanish market has adapted from its position pre-global financial crisis and is better prepared for the challenges ahead. At KBRA, we actively monitor the markets and keep you updated. You can find our latest reports on the topic and related information on kbra.com, where we regularly comment on everything from residential mortgages to project finance. A recent topic of focus has been the rapid rise in interest rates as central banks look to curb the surging levels of inflation. Both inflation and rising rates will present challenges to housing markets across Europe and the globe. These combined factors are likely to squeeze consumers and households, putting pressure on their ability to meet their mortgage obligations or even affordability to purchase a new home. In Spain, the market suffered dramatically in the wake of the global financial crisis, with house prices collapsing and delinquencies and defaults surging to a point that the government was forced to support the banks with the creation of an asset management company to take on some of the bank's challenged portfolios. In 2023, the market will be challenged again, but we would argue that it is in a much better position than it was in 2007. Here to provide us with their expert opinion on the topic is Kali Sirugudi. Thank you for joining me, Kali. Let's start with a picture of house prices. Across Europe, house prices have been rising since their lows of around 2013 to 2014. How has Spain fared in comparison?
Hello, everyone. Thank you, Gordon. Prior to the global financial crisis, house prices in Spain surged to high levels and displayed elevated growth compared to other major European housing markets. And subsequently, Spain's housing market collapsed, with prices falling to a low in Q1 2014, an approximate 40% decline from their peak in Q3 2007. Now, since those lows, the European housing markets have slowly recovered. However, they've not all recovered equally. Spain's recovery has been relatively modest in comparison to other European economies. For example, Portugal, Netherlands, and Germany have experienced very high levels of house price growth, ranging from 99 to 109%, in contrast to their lows, and are now far above their prior peak levels. In comparison to that, Spain's prices have yet to recover to their 2000 peak, although they are nearing their prior peak levels, appreciating only 49% from 2014. Now, the growth has outpaced some European economies, such as France with 39% and Finland with 35%, which display a relatively steady annual growth. In Italy, prices remain suppressed largely due to the country still emerging from a sizable non-performing loan crisis. So one of the countries where we have been actively rating issuance backed by residential mortgage loan portfolios, Ireland, recorded a similar situation to Spain, but house prices there have recovered to a level closer to the peak pre-global financial crisis, climbing 118% after falling steeply through the global financial crisis. The index of average European house prices in the euro area is marginally above Spain and has shown 48% growth from Q1 2014.
Thanks for that, Kali. So the market, in terms of the Spanish market, is not really showing signs of overheating or overexuberance. What about the underlying factors that are supporting the housing market?
So for starters, one of the reasons for the prior growth in Spain's house prices was strong demand for housing, supported by a supply of financial leverage. So the boom in house prices and new builds turned into a large supply overhang, something similar to what we have seen in Ireland when the country's financial and banking systems faced a difficult environment. The current environment is supported by a heavily decreased supply of new builds, a diminished supply of repossessed housing, and a decreased level of household leverage. The annual housing completions, which you observe in Spain now, have collapsed to a low of 35,382 units in 2014, down from a peak of 597,632 in 2006. And that's a dramatic 94% contraction in housing supply. So development has since increased from that low levels to more than double 2014 levels, but remaining well below the peak levels and below half of the annual average throughout the 1990s. Further to the diminished supply from new builds, there has been a decrease in the supply of bank-held properties. Many banks held defaulted developer and mortgage property loans post-global financial crisis, and a large volume of defaulted loans were transferred to SARIB, as you mentioned, Gordon, in your introduction. Now, SARIB is guaranteed by the Spanish government, created in 2012, to sell and manage the loans and properties from rescued banks. They have been selling off properties and finishing incomplete properties in preparation for sale. And this supply has decreased by 43% of the transferred loans and properties to SARIB. So now this has been carefully managed with assets drip fed into the market to avoid disruption.
Thanks, Kali. As you mentioned before, one of the areas that supported the prior boom in house prices was the availability of mortgage lending. How has this side of the market developed since the global financial crisis?
So since 2007, household lending has decreased dramatically. At the peak of mortgage lending, the new monthly volumes of mortgage originations was at 18.5 billion euros in Spain. And that fell to a low level of 1.2 billion euros on a monthly basis in August 2013. It has recovered to about 5.3 billion euros on a monthly basis in July this year. Now, while that run rate of originations is still well below the peak levels, it is mainly driven by households which are now, or rather seem to be less keen to take on high levels of borrowing, and that has led to decreased levels of home ownership within Spain. This is evidenced by the levels of loan to value ratios. While they have returned to a level above their pre-GFC peak for new loans, they have only done so marginally. Between 2004 and 2007, LTVs for new originations range between 62 and 65%. They fell, or rather, the leverage fell to somewhere between 55 and 60% post-global financial crisis. That is between 2009 and 2014. And since then, they average about 65%. So while on the surface, the increase in leverage in recent times would appear to show a return to the leverage pre-global financial crisis, percentage of these loans at high LTVs, particularly above 80%, has declined. So that percentage of loans above 80% LTV as a proportion of new loans originated has decreased from somewhere between 14 to 18% pre-GFC to about 9% in quarter 2, 2022.
Right. So with interest rates increasing, there has been a great deal of discussion about how high rates are for Spanish and European borrowers and how they are positioned for the challenges ahead. How is the market in Spain prepared for these increases in interest rates?
Yes, that's an interesting question. Of course, what we've seen in Spain in terms of mortgage rates for the last decade or so, the rates have fallen in line with the declining interest rates. And this matches the overall trend in rates across Europe. Looking forward, interest and mortgage rates are predicted to increase, likely placing pressure on borrowers and raising the cost of borrowing. However, the evolving scenario in Spain over the past several years for mortgage rates has been different to many European markets. Now, Spain has a largely floating rate mortgage market with payments typically based on 12-month Euribor rate. However, the mortgage borrowers are increasingly migrating to fixed rate loans owing to a combination of factors, including the Euribor rate, which is at the lowest in recent years, increasing the appeal of locking in the low rates for borrowers trying to borrow for the purchase of a property. Further, several controversies disenfranchised borrowers due to treatment of floating rate borrowers. The first was the use of the mortgage rate floors. Because of these floors, the borrowers continue to pay a higher rate of interest as compared to where the Euribor rates were, near zero or negative. The other thing, which was the use of IRPH, which is the indice, the reference here, the Préstamos Hipotecarios, which is a bank-determined reference rate for variable rate loans, which is theoretically less volatile than Euribor, but is set at a premium over the Euribor benchmark. So, and there was also a lack of transparency about the use of IRPH, and consequently, borrowers have been taking their banks to court on the basis that they were unaware they would potentially pay more than on a Euribor-based mortgage. Having seen the back of the issues and the problems with the rate setting for variable rate loans in Spain, as of August 2022, we see that the rates have increased to above 2%, which is up from a low of 1.5% in December 2021. It is likely that the mortgage rates will continue to increase. And the highest rates over the past 15 years was at about 6 to 6.2% in September to October 2008. Borrowers have increasingly opted to take on a fixed rate loan. And as of 2022, over 70% of new originations were fixed rate. Now, borrowers will typically fix their rates anywhere between 2 to 5 years, but can be for longer, with offers of a fixed rate for 10 to 25 years common. Until December 2015, less than 10% of new mortgages were fixed rate transactions after a long period of mainly floating rate mortgages. These have increased to 73% in July 2022.
Thanks for that, Kali. Now, looking forward, there are likely to be challenging times ahead for mortgage borrowers. What are you seeing with respect to performance in residential mortgages so far?
Right. On performance, the delinquencies and defaults on mortgages in Spain are highly correlated to the level of unemployment. And we've seen the unemployment story of Spain now. Post-global financial crisis, the unemployment reached the highest levels of 26.4%. That was in February 2013. Now, the unemployment increased during the COVID-19 pandemic to reach about 16.5% in August 2020. But the current levels are below the pre-pandemic rates of 13.7% in February 2020. And as of September 2022, the unemployment level is at 12.7%. Now, that is relatively positive for the ability of the borrower to be able to service their mortgages on a regular basis and supports the expected performance of mortgages in Spain. To give you a little bit of history there, in 2008, doubtful accounts, delinquent and likely to default, held on bank balance sheets began to rise from a low level as the economic downturn took hold and unemployment increased. The level of these mortgage loans was moderate at the beginning of the GFC, as many banks offloaded their doubtful accounts to SARIB, which was in 2012. However, doubtful accounts escalated as conditions deteriorated and unemployment increased in 2013 and 14 to a peak of 26%, as I mentioned before, in 2013. Doubtful mortgage loans reached a high of 6.3% in March 2014. And have since been on a downward trajectory. As of June 2022, housing lending deemed doubtful was at 2.7%, which is still above levels prior to 2012, but remains far below the peak levels. But despite concerns, the expiration of a mortgage moratorium in March 2021 did not result in large increase in repossessions, while the level of doubtful accounts continued to decline in June 2022. Mortgage doubtful accounts held within bank balance sheets may not have increased as outlined, but mortgage borrowers have recently shown signs of higher delinquency rates within residential mortgage-backed securities. According to data from the European Data Warehouse, borrowers of loans in residential mortgage portfolios over 3 months delinquent have increased to 2.1%, up from 1.5% in 2021. These are clearly depicted in some of the charts we have put up in the commentary on KBRA's website. These are the highest levels in 5 years, but remain below the 4% level seen in 2014. Delinquencies are likely to continue to increase as borrowers struggle with the rising cost of living and increasing interest rates. However, the Spanish government is proposing some changes to support more vulnerable borrowers, with proposals where the mortgage interest rate could be reduced, which could also be combined with the extension of the term of a mortgage. We are keen to see where those discussions with banks go and what the effect of those proposals, if implemented, affect delinquencies and defaults in Spain.
Thank you very much for your comments, Kali. As you can see, the current market situation is likely to negatively impact the real estate markets across Europe. Rising rates have an impact on borrowers, and Spain will not escape this situation. But the market there is better prepared for a downturn than it was in 2007. Property valuation increases have been moderate. Leverage is not a major factor in the growth of the market. Many borrowers have prudently fixed their rates, and there is a positive employment picture for now in Spain. The full impact of rate rises and inflation on borrowers has yet to be fully worked through the system. There are proposals in place to potentially help and assist borrowers from those extreme rate increases as they filter through. But in our view, the Spanish market is better prepared than it was in the past and should be able to weather the downturn depending upon how long this current scenario lasts. We at KBRA are actively monitoring the situation. Make sure you are registered on our website, kbra.com, have subscribed to our podcast, and of course, are engaged with our experienced analysts. Thank you very much for listening. We look forward to bringing you more conversations in European credit. Stay strong out there as we all navigate through this challenging environment.
This concludes our episode. Please continue the conversation on LinkedIn and Twitter at Kroll Bond Rating. We'd also like to remind you that all of our ratings and research reports are available at kbra.com. Lastly, please share any feedback or ideas for future podcast episodes by emailing us at media@kbra.com. We hope to see you next time.